Okay, so we're now into the third item in our triple threat panel here. Financing Dies in Darkness, the Impact of Newspaper Closures on Public Finance. A very interesting paper. And Dermot Murphy is going to be presenting the results of this paper. He's an assistant professor of finance at the University of Illinois at Chicago, who specializes in public finance, fixed income, and high-frequency trading. Two of his recent studies have been accepted for publication at the Review of Financial Studies and the Journal of Financial Economics. One of his current research projects examines the effect of local newspaper closures on public borrowing costs and has been covered by Forbes, Bloomberg, The Guardian, The Atlantic, and NPR. He earned a PhD in finance from Kellogg School of Management at Northwestern. Go Northwestern, my dad went there. An MSc in finance from the University of British Columbia, and a joint undergraduate degree in business and math from Memorial University of Newfoundland. Welcome.
All right, thank you. All right, so thanks for having me here today. So yeah, that's the title of the paper, Financing Dies in Darkness, the Impact of Newspaper Closures on Public Finance. Financing Dies in Darkness, of course, that's a bit of a play on the Washington Post byline. So let me talk about the state of the local newspaper, first of all. So they have essentially been in decline since about the early 2000s. So according to Pew, here in DC, circulation numbers have been down about 27% from 2003 to 2014, and that represents a decline of about 15 million subscribers. Now, importantly, during this same period, the number of full-time State House reporters was down about 35%. So this is very important for our purposes because that means that governments are not being watched as closely. So there's an FCC report in 2011 that stated the following: in many communities, we now face a shortage of local professional accountability reporting, and this is likely to lead to more government waste, more local corruption, less effective schools, and other serious community problems. And I couldn't resist putting up an example of an article from my current home state of Illinois. Part of the motivation for the paper came from an excellent segment by John Oliver on his show Last Week Tonight with John Oliver. He was covering the state of local journalism back in 2016. And he said that local journalism is very important and that television stations and online news sources, they frequently rely on research that is done by local reporters. He says that those places, internet sources especially, often just repackage the work of newspapers. And he says, watch how often TV news ends up citing print sources, and he even refers to his very own segment that says that all the research they did comes from local newspapers. And he finishes by saying, not having reporters at governors' meetings is like a teacher leaving her room with 7th graders to supervise themselves. David Simon, who's well known, and he was a former Baltimore Sun reporter, in 2009, he was talking about the future of journalism in Senate hearings. He stated that you do not in my city run into bloggers or so-called citizen journalists at City Hall or in the courthouse hallways or at the bars where police officers gather. And he also said that the next 10 or 20 years in this country are going to be a halcyon era for state and local political corruption. It's going to be one of the great times to be a corrupt politician. I really envy them. So big problems, and I'll get to our perspective shortly, because we're finance professors, so we'll be looking at these problems from a finance perspective. But we can see that newspaper closures, they're well distributed over time. So we collected newspaper closure information from the editor and publisher yearbooks, and we saw that, okay, since 1996 to 2015, there have been plenty of newspaper closures, so they're not concentrated in the recession or anything like that, so we do have a good distribution here. Furthermore, we have a good distribution of newspaper closures geographically, so they're not concentrated in a geographically or an economically depressed area. Like they're not concentrated in the Rust Belt, for example. So this is a graph of newspaper closures from 96 to 2000, but you can see that the newspaper closures definitely spread over time. Going up to 2015, we do have a pretty good distribution, or pretty bad distribution, you could say, of newspaper closures throughout the country. Why do newspapers close? I think we pretty much know the reason for this. One of the reasons is that there's been a decline in readership because the internet mostly has become a viable alternative for gathering your news. especially among young people, of course. But there's also been a significant erosion of advertising revenue from search engines, for example, and from Craigslist. There was a study that showed that Craigslist cost the newspaper industry about $5 billion from about 2000 to 2007. So they're not the sole cause of newspaper closures, of course, but they were one of the contributors. And according to Pew, again, you can see that there has been an uptrend over time of where people mainly get their news, and nowadays it's mostly from the television and internet. And this is as late as 2013. I'm wondering if the internet has since overtaken television. And here's an interesting closure example. So I think that Denver is a very interesting area right now for studying newspaper closures. So the Rocky Mountain News was a fairly substantial newspaper in the Denver area that had a circulation base of about 250,000 subscribers. And they closed in 2009 due to declining circulation numbers and advertising revenues. And we looked into the Rocky Mountain News, and they did provide valuable coverage of local governments. Issues such as a potentially illegal deal between the city and Lufthansa Airlines, and they discussed a lack of oversight of the so-called special taxing districts in the Denver area, among many other issues. So here's our main question, okay? How do local newspaper closures affect public finance outcomes in the long run? So our proposed channel is this. We believe that when a newspaper closes, there is a loss of a local government watchdog. And if there's no more government watchdog, then that means that governments are more likely to engage in bad behavior. If I, as a lender, want to lend to a local government, I might have to ask for a higher interest rate to compensate for lending to a riskier government that may be deemed or seen as more corrupt. So to conduct this study, we do collect data from the editor and publisher yearbooks to identify the newspaper closures. And then we cross-reference this information from the Mergent Municipal Securities database. So we have information about offering yield spreads, essentially, from 1999 to 2015. So we're going to be looking at how yield spreads react to newspaper closures, and we'll get into establishing causality a little after that. So here are the baseline results. I just put it in bar graph form. I didn't want to have too many numbers on the slide. So we looked at both all bonds and revenue bonds. So this is the result from a multivariate regression. And the pre-closure period is the blue bar. And that basically looks at counties which are going to experience a newspaper closure but haven't yet, versus counties that will not or have not experienced a newspaper closure. And there's no difference before the fact between the counties that are going to experience a closure and ones that did not. So there's no difference beforehand. But after the newspaper closure, that's where we see the big effect. Okay? After the newspaper closure, we see that bonds in the closure counties are about 5 basis points higher than the matched counties that did not experience a newspaper closure. And we find that this result is even stronger for the revenue bonds. So revenue bonds, of course, are backed by cash flows generated by specific projects. And it was our hypothesis that these are cash flows that are more likely to be misappropriated. So there's going to be more of an effect here. So they're more corruption prone, you could say. And this is where we see a much bigger effect. We see that there is about a 10 basis point effect of a newspaper closure on borrowing costs for revenue bonds compared to revenue bonds in counties that did not experience a closure. 10 basis points is high in the fixed income world. We calculate that as about 25% of the risk premium on a risky bond versus a bond that is not risky. So that is pretty substantial. And so what's hidden in this graph, of course, is that we control for many things. We control for state year fixed effects to make sure that we're looking within state and year, and that also helps to control for statewide recessions and actually countrywide recessions. We also control for time to maturity, whether the bond is general obligation, the size of the bond, whether the bond is insured, and so on. Lately, we just did an adjustment for the call feature on the offering yield, so that we just looked at the straight bond component and we just removed the call option feature, and our results still hold. In dollar terms, we find, using a back-of-the-envelope calculation, that this newspaper closure effect leads to an additional $650,000 in interest on the average loan in present value terms. And we consider this a lower bound estimate, in fact, because a municipality does need to take out many loans over time because they're constantly funding different projects. And we also consider this a lower bound estimate because if the newspaper closure problem or the coverage problem continues to worsen, then we could see interest rates getting even higher, especially if we manage to extend the sample period. We wait another 10 years and so we see how things look. The effect is especially pronounced in low newspaper counties. These are the counties that didn't have many newspapers in the first place. So we compare the effect in low newspaper counties to high newspaper counties, and we see the effect is primarily felt in the low newspaper counties. So what I'm saying is that places that are kind of news deserts in the first place, if they lose like their only source of news, then things get much worse. So it's the news deserts where things are especially felt. We have a nearest neighbor test to help further establish causation. So we look at a county that experienced the newspaper closure, and we look at one of the county's neighbors in the same state that is matched on economic and population characteristics. We think that the counties that are neighboring each other are more likely to be correlated economically, and they do have similar characteristics because of our matching procedure. And we do find that the county that experienced the newspaper closure does have a significant increase in their yields, as opposed to the county that did not experience a newspaper closure that's neighboring. The yields stay mostly the same. One more causality test is our two-stage Craigslist test. So we found this Craigslist instrument useful for our purposes because Craigslist was slowly rolled out to different counties over time. So we examined the effect of Craigslist on the probability of a newspaper closure, and we think it's unlikely that the entry of Craigslist is going to lead to increased yields. So what we see is that when Craigslist enters an area, we find that the probability of a newspaper closure goes up by about 10%. Again, we're not necessarily saying that Craigslist was solely responsible for the decline of journalism, but this is, again, a useful instrument because it was slowly rolled out over time. So it was one of many negative shocks to journalism. So the probability increases by 10%, and the knock-on effect on yields in the second stage regression is about 4 basis points. So this helps us establish causality again, that there is actually an effect of the newspaper closure on public finance outcomes. We have some additional tests that help to drive the point home. So we look at closure effects by state type. So one of the first state types that we look at is the differential effect by political isolation. So Campanti and Doe have shown that there are states that are more politically isolated because their economic center is far away from their political center. So one example, again, is Illinois, Chicago versus Springfield. And so what they show in their paper is that corruption is more likely in the high political isolation states. And so we decided to look and see if there's a differential effect on the high political isolation states versus the low ones. And we do find a significant effect. Although newspaper closures do have an effect in both types of states, the effect is much bigger in the high isolation states, essentially, where there's more likely to be more corruption in the first place. The second state type regression we do is we look at the differential effect by internet usage. So we identify states that have high internet usage versus low using information from the National Telecommunications and Information Administration. And so we think, well, if online sources are providing a really good substitute, then you should see that there isn't much of an effect in the states that use the internet more. But we're not really seeing a differential effect here. We're seeing that there is a slightly stronger effect in the low internet usage states than the high internet usage states, but we're not seeing any statistically significant difference. So, our takeaway from this regression and our overall study actually is that we don't think that internet sources are necessarily providing a perfect substitute for the information provided by the local newspapers that were in the area. The last part of our paper, we examined government inefficiencies after a newspaper closure, and we do see evidence of increased government inefficiencies as well. So we look at negotiated sales, for example, which are typically associated with higher yields, and we see that the likelihoods of negotiated sales are higher after a newspaper closure. along with advancer fundings. Also more likely, and research has shown that advancer fundings are costly, that they're usually negative NPV propositions. And we look at some other government inefficiency metrics, and we do find that government wages as a percentage of all county wages increase. Governments are paying themselves more government employees compared to the employees in the county, and higher taxes per capita for residents of that county of about $85 per person. So our conclusion is that public borrowing costs increase and government inefficiencies become more pronounced following a newspaper closure. And our main takeaway is that local newspapers do play an important watchdog role for local governments that is not easily substitutable by other sources. So one possible policy implication is maybe there should be more state funding for local journalism initiatives. And I'll end with this quote from David Simon again. The day I run into a Huffington Post reporter at a Baltimore zoning board hearing is the day that I will be confident that we've actually reached some sort of equilibrium. But I don't know what equilibrium we are at yet, but we shall see. So, thank you.
All right. Last but certainly not least, Leslie McGranahan is a Vice President and Director of Regional Research in the Economic Research Department of the Federal Reserve Bank of Chicago. She will be the discussant for this paper. Her primary research interests relate to the effect of federal, state, and local government policy on individuals and households. She has written about numerous government programs, including the Earned Income Tax Credit and Child Tax Credit, the Supplemental Nutritional Assistance Program, and the sales tax. She also closely follows regional and national developments in government spending and tax revenues. McGranahan's research has been published in journals including the National Tax Journal and the Journal of Political Economy. Her work has also been featured in the Chicago Fed Letter and Economic Perspectives, the Federal Reserve Bank of Chicago's publications. McGranahan returned to the Federal Reserve Bank of Chicago in 2004 after working as a lecturer at the University of Warwick and as a research economist at the Institute for Fiscal Studies in London. She's received a bachelor's degree in politics from Princeton and master's and doctoral degrees in economics from Northwestern. Great.
Okay, thanks. So, this paper has been really eye-opening. Actually, it's been kind of neat to sort of follow, look at newspapers and look at the newspapers you see and see what they cover and who covers them. And so I want to start and just say, like, the main conjecture in this paper is actually really well documented. First of all, that newspapers think of this as their role. So I looked really quickly, because we're both from Chicago, what does the Chicago mission statement of the Tribune say? It says, the Chicago Tribune is a citizen of Chicago, a newspaper committed to inform and lead public opinion, to foster commerce and industry, and to furnish that vital check upon government which no constitution can. So the Tribune, in its mission statement, the commerce and industry thing is interesting because it was founded by Cyrus McCormick, so there's sort of this industry past, but also that it thinks of itself as serving this watchdog role on government. And if you actually look at some of the statements from people in the government, they also think of the newspapers as watching them. So there was something. Someone asked about something going on at the Denver Post, and when the reporter was going away, the response was, if there's no reporter, somebody from the government said, hey, that means we can do whatever we want. And so, I hadn't really thought about this. I don't know if you had seen that quote as well, but like this notion that the newspaper thinks it's their job, and that the government thinks that's what the newspaper is doing in part. So the paper finds that sort of two things happen once the newspaper closes. First, public finance spending increases. So the wage bill goes up, the public employees increase, and tax revenue go up. And so the paper sort of views this as inefficiency. My take on these particular things is that it's less government efficiency and more something like government size. So the size of the government is increasing. And this seems to match, in my mind, like something like a sort of a Brennan and Buchanan Leviathan model of government, so that nobody's watching, and so that the public employees or the leaders who have a sort of taste for a larger government sort of get their way without the watchdog role of the newspaper. So I was kind of a little bit challenged by the notion of inefficiency. The other inefficiencies, or sort of the notion that things change in the bond market, are a little bit more outside of my area of expertise. So the notion that more of the change in the bond market may be something that seems more like an inefficiency to people more broadly. I thought these measures of government seem more to be saying something about government size. So the sort of public finance spending increases and municipal borrowing costs increase by 5 to 11 basis points. So the yields go up. And I think when you look at the abstract of this paper, the first response is that there's going to be some sort of omitted variable bias, right? That there's something that's causing the newspaper to close, that's causing stress in these jurisdictions as well. And I was sort of thinking, like, sort of, you have something like a Janesville story that the GE plant closes, the city residents can no longer support their paper, and they also can't issue a bond. And sort of that's sort of the first worry you have when you read what they're doing in this paper, is that there's some sort of omitted variable bias. And I think there are sort of three things that made me, by the time I sort of read through this, come away with not worrying about that nearly as much and not really worrying about that at all by the end. First is that map, where you see that the location of the closures don't necessarily seem to correspond to what we think of as places that had unusual levels of stress. It's not focused all along the Rust Belt. The second is the timing of the newspaper closures, which don't really seem to follow the economic cycle in a real sense. And finally is this Craigslist instrument. And the Craigslist instrument is like on page 20 of the paper, and I think it should be like on page 3, because the Craigslist instrument is really what makes a reader believe the underlying mechanism is actually working in the way it's stated. It's a really amazing instrument, in part because the bias seems likely to run the other direction, in the sense that if you think of where Craigslist was most likely to open, it's more likely to be in the places that were doing relatively well. And so insofar as it would have caused a newspaper to close, it was sort of leaning against the wind, because Craigslist is more likely to go into thriving areas, I would think. So that's sort of the main conjecture being well documented. Yeah, I think we don't have a ton of time, and my slides are pretty short too. So the other questions that I had after, I felt like the main mechanism was, the main results was well documented, and wanted to push a little bit more on what the mechanism is that is causing these changes. And really, I think that the main point is just the sentence here is that, is this really about something that's happening in the bond market and the structure of the issuance of debt? Is it something that's happening relative to the credit worthiness of the borrower? The borrower is getting more risky? Or is it something about the information set of the people who are lending to the municipalities, in particular because so many of these bonds are bought locally. So as the local residents are getting less information, maybe less positive information as well as negative information about their government, they need to be compensated more. And I would like the paper to spend a little bit more time really teasing out which of these mechanisms corresponds to the set of facts. And one of the ways I thought the paper could do more of that is really by tracing out over time what happens to different bonds. So like for example, if there's a bond that's already out there and has been issued, and then the newspaper closes, what happens to that bond as opposed to new issues and as opposed to future issues? So I'd like to see the things traced out more over time. Just the other thing is just, is there something going on about different levels of government? So while the county newspaper is the unit of analysis, the newspaper closure, the issuance are all across the different types of issuers. And so there could be changes in coverage based on the type of issue. In particular, things like school districts, no matter what, get a ton of coverage, but they may lack thoughtful analysis, but they may be getting more coverage, for instance, in something like a special district. And okay, just just the last thing is maybe a little bit something encouraging, sort of at the end, is may we be seeing the pendulum swinging in the other direction? Are there signs that the equilibrium is going towards maybe the Huffington Post person being at the bond hearing? And I think that one of the things I was excited to see in your graph is that more people are listening to the radio, and this seems to be somewhat of a golden age of public radio, and maybe there's some sense in that public radio is picking up the slack. We had a meeting recently with our local public radio station, and they're doing great. Now, maybe this is a very anecdotal thing, and maybe people are more informed about what's going on within public radio, but my sense is maybe they're picking up some of the slack, and their reporters are doing some things. And the other thing is the hyper-local news. I know that in our community, there's a ton of coverage of obituaries and sports by 14 different little publications. And I was wondering whether there's some sense that some of these smaller sort of hyper-local sources that have the ability through the internet to get to a very localized population are helping some of this underlying problem. But I'll leave it at that so we can ask good questions.
Yes, absolutely. Okay, great. Dermot, any thoughts in response or reflections on those comments? Yes. Okay.
Well, first of all, thanks for the great discussion. Yeah, you mentioned that government inefficiencies, it might just be a proxy for increased size. I think I agree with that statement. And it also depends, too, on whether you think a bigger government might actually be a more inefficient government. I'm not sure. As for Craigslist, you said it should work in the other direction. To push back on my own paper, I know that somebody mentioned before that, Craigslist might be entering counties where people are more receptive to buying secondhand goods. Maybe that's why you would see that correlation. So I don't want to push on that too much because I mostly disagree. But I just thought I'd mention that. You mentioned something about the different levels of government. We do have sector level information, so we haven't looked at it yet, but we would like to see if the effect is strongest for a certain type of sector, such as education. That's an excellent idea. You skipped past a slide that said sports on it. We're currently doing a text analysis right now of newspaper articles that have had things like local government, fiscal, mayor, and so on that appear in it. But we also use as a control the word football. So we're comparing football to fiscal issues right now, which ties right into your comment. And I think that's all I have. That's good.
Great. Handful of questions? Yes.
Hi, it's a really interesting, Tracy Gordon, Urban Institute. It's a really interesting paper. I just want to amplify some of Leslie's comments. I'm still concerned about the mechanism. So the idea that lenders are somehow seeing these places as more risky, I just have this feeling that, the bond market vigilantes are not going to save us. Lenders don't care, right? Lenders care about getting paid. And I think that the fact that you're finding a strong effect for revenue bonds rather than GO bonds, if reputation was the primary mechanism, then that doesn't seem right, if there's a secured source of payment for the bonds. So I'm more inclined to think that riskier projects are going forward, and so I think Leslie's idea about looking at outstanding bonds versus new issuances is a really great idea. When the newspapers close down, if the people who are in charge are no longer evaluating projects as carefully, then you should see an effect for the new issuances, but not necessarily the bonds that were issued before the newspapers closed down. In terms of Craigslist as an instrument, it sounds so cool, and I sort of wish I believed it. But I'm sympathetic to the causality thing, because when you're talking about something, what I'm going to propose is sort of a time shift or a shift in preferences, right? A time varying, unobservable that you can't really address. So I used to live in San Francisco when Craigslist came around. The receptivity to Craigslist as a substitute to local newspapers, I think, says a lot about the population, the degree to which they're engaged in local politics. So I remember it was the time at which sort of the green candidates for the city council were sort of a big deal. And I was talking with someone about the Senate Pro Tem, John Burton, who was sort of a lion of the California Senate, and mentioned something that he was doing. And this person said, I only follow the liberal politicians, right? So to my estimation, that was sort of a sign that she was just checked out of local politics. So the degree to which people accept Craigslist or the Huffington Post as a substitute for these local papers, I think says a lot about underlying preferences. So if you could somehow sort of get at this project quality issue, I think that would help explain what's going on here a lot more.
Yeah, that's an excellent point. We'll look into that. So I think that we can see the differential effect on bonds that have lower credit quality. You mentioned about secondary market yields. I didn't mention that in the presentation, but we do also look at secondary yield data from the MSRB EMA database, and we find that there's an effect there as well, actually. So we were motivated to look at revenue bonds in the first place because, we did see anecdotal evidence that cash flows from these types of projects could be misappropriated from a stadium, for example. So we thought, we could possibly see a differential effect, like a larger effect on these bonds if our mechanism holds. So we're hoping that helps support our story and convinces people.
I would just think that when the issuance goes forward, that the offering statement could cover things like accountability and the ability to redirect revenues, right?
Yeah, I would imagine so. I'm thinking that this is more based on soft information, so you don't only rely on the prospectus, for example, and so whatever you think you know about the local government or what you don't know could factor into the pricing.
Okay, I see we're at 10:15 and maybe a minute or two after. Thanks to all the panelists. Thanks to all of you. I think we give us all a big round of applause here.
Thanks for watching. Be sure to like and subscribe for more videos from Brookings.